Uh, Good morning, good afternoon, and good evening, everybody. Thanks for joining this webinar about accounting and chargeback. We'll go through this practice, which is part of a broader capacity management practice, and we'll explain what is accounting and chargeback, what are the benefits, the challenges, and how to implement this practice within your organizations. Um, and as I was saying, the speaker for today is our own Renato Bonomini, Director of Business Development at Moviri. His background is in digital signal processing and high-performance computing. Some of you already know him, some don't, and you will appreciate his knowledge around capacity management in general and this specific topic. He is an expert in architecture and design of capacity management from a technology, from organizational, and from a process perspective. And in his spare time, he really likes to ride his Ducati. He's really a fan, and his ride is a really nice one. And as you can see, he's also his relief from stress. And with this, I would like to hand over to him to walk you through the agenda for today. We will have some handouts available, and at the end, we will have some time for question and answer. Renato, now all yours.
Thank you, Gabriele, and thank you everyone for attending today. This is one actually of my favorite topics, so I'm really glad to see so many of you attending today, and I hope that'll give you some insightful tips and some insightful information about accounting and chargeback. Now, for today, we have an agenda, and there is a lot of information that we could have shared, but keeping this to a limited amount of time, we're going to focus on very important topics. So first of all, we'll go through why doing accounting and chargeback in general. What are some of the reasons why companies go through all of this effort to set this up, and what are some of the goals associated to it. Next, we'll go through some of the techniques that are available, some of the methodologies. There are several, not a single one is best, so we'll take a look at what you can actually do. And then we'll start taking a little bit outside of the area of description, generic concepts, and so on, and we'll go into the specifics of how this can actually be done with TrueSight capacity optimization, which is the product from DMC Software, where we have the most experience in supporting organization with. And then at the end, we'll take a look at some of the common challenges and the lesson learned that we have found while working with the organizations that we partner with. And hopefully we can spare some of these challenges and you can actually already know how to go around them. We'll take question and answers at the end. And as I was mentioning, will be probably around about 45 minutes. So let's start right away. First question, why are you all here today? Why are you spending some time with us? And thank you again, by the way. Let's take a look at, for example, a little story. Now, once upon a time, there was this company and they had IT costs like most of you do. And they had a question, how do we internally charge back the cost that we incur in IT? And what finance came up with was a very simple exercise of using headcount. So there used to be, as you can see there in the picture, about an equal amount of resources used by accounting and an equal amount of resources used by sales. The accounting team was much bigger than the sales team. So at the end of the day, from an accounting and chargeback perspective, accounting was indeed using 50% of the cost because they were using half of the IT infrastructure, sales the other half. But accounting incurred 66% of the charges. So when internally someone from finance went back and looked at the BUs, in this case, let's just take the example of a couple BUs, the bill said, hey, dear accounting department, you have to pay for 66%, and sales, you have to pay for 33%. Everyone was happy that was the way that it always been done, and the idea was the more people you have, the more IT support you need, so the more you pay. What happened when things change over time? Well, the nature of doing business changes over time, so how people use IT actually changed. So at one point, sales were moved online. What happened is that, as you can see, some of the salespeople found another job or just let go. And what also happened is that in order to do sales online, the amount of IT resources were actually much increased. So they actually doubled the amount of IT resources. If we keep using this headcount to charge for the internal cost, we can see that, well, the amount of resources that sales uses is actually increased. It has doubled. The amount of people has decreased. But now for a second, look at let me circle it right here. Look at the cost. So now sales is actually, if we look at this, it's generating 66% of the cost, but it's only paying for 20%. And most of the cost is actually being paid by accounting, which is using less. If you compare to how much cost was being used before and after, this doesn't look like a good exercise. So the initial idea of doing headcount was very simple, very easy to explain. It turned out to be a terrible idea. And this is actually an example that we have out of a company that we work with, that they used to do headcount, and because it was simple, and then they found out that it was really, really unfair to how a company was actually doing business. Now, some of the common questions and reasons why there are so many methodologies of accounting and chargeback, and why people spend so much time in even inventing new ones. Let's take a look. First of all, a very simple question to which the answer is quite complicated. Where is my money being spent? What are the services that cost us most, and why as well? How is the money being spent? That's a very common question that most of you have probably received in your lifetime. The second one, where are the volumes and types of being consumed services? So where is my infrastructure actually being used, and is it being used, and does it correlate to how much business is being generated? So this is actually similar to another goal, which is how do we set baselines to understand how much we are efficient, and how do we improve how much cost effective we are? And accounting and chargeback not only serves the purpose of creating internal accounting and telling, hey, sales BU, you're costing this much to the company. It also serves as a way to make sure that you can improve your cost efficiency, and you can create a baseline and understand how well you're doing. The whole idea is that if you look at your own organization from an IT perspective, you probably fall into one of these three categories. Either the internal service provider, you have BUs that have their own IT, or you might be working in a shared services unit. The company has IT as a business unit, which serves all of the other business units. Or you might be outsourcing your IT, the external service provider point of view. One of the reasons on actually setting up an accounting and chargeback is not just to create a bill of costs, but also to try to, if you belong to the internal service providers or the shared services unit, you want to change how you work so that you can actually gain the efficiencies of outsourcing your IT. So most of the companies say, well, we'll take our IT, we'll outsource it so that it's most cost efficient, we can control costs better, we can drive costs down. Well, one of the ideas of accounting and chargeback in particular is to do the same, to take the benefits of running IT from an outsourced company, but actually use the same methodology of cost control for internal resources. That's what, for example, accounting and chargeback also wants to do. Now, let's take a look at what you can actually do and some of the clarity on the goals and what needs to be done. First of all, there are three sub-processes of accounting and chargeback. The first one being identifying costs. What is the actual object that generates a cost? That sounds like a very simple question, but it's one of the most complicated exercises. First step is identifying what generates a cost. The second activity is allocating that cost to someone. Well, there is a cost somewhere, someone has to pay for it, and that's what we call cost allocation, which in other terms means distribute the cost to the targets. And you can see some of the terminology that we're going to use, which are common across IT financial management in general. These are not very familiar names and not very easy to understand. What is a target? Target in this case is someone that receives a bill of consumption, someone that has to pay back the company, like a BU, for example, a business unit. That could be a target. And last, we identify how to recover this cost. And that's an area where there's a lot of many different ways on how you can do it. We'll take a look at that in a while. So let's start with the first area, cost identification. There are so many ways on how you can actually do this. And let me just make one extreme or the other extreme. There is a bottom-up approach, which we can call utopia. And there is a top-down approach, which sometimes is called rough justice. Now, the bottom-up approach is what every single good engineer, and guilty, I'm an engineer by training and by nature, will come up with. We go around our data center and we take a look at how much space, how much power bill we are spending, how much UPS is costing us, the generator, the racks, the cable, the storage, network devices, the connectivity, servers, software licenses, employees. Star Trek reunions, we need to put them into the IT cost as well because our IT department is very Star Trekky. We gotta pay Dilbert calendar. So you take every single thing you have in your data center, every single thing you run in your IT, you sum them up and you understand what is the type of cost, the amount, the amortization period. Now, I guess you feel that at this point, looking at the bottom-up approach might sound a little bit complicated. That's exactly what everyone would do. They will start looking around. What is the single cable costing us and who has to pay for that single cable? It becomes really, really easily unmanageable. The other approach, which is probably a little unfair to most, but it's actually very reasonable, is to take the total expenditure and divide it fairly, whatever fairly actually means. And you're done. So a lot of companies will end up starting with a bottom-up approach, realizing that it's unreasonable, and then they will take the rough justice. And as you can see there, for example, that comes out of something which you might remember from middle school or high school, Greek mythology. Daedalus has his son Icarus, for we build wings. And it tells Icarus, son, remember, don't fly too high, don't fly too low, just stay in the middle. And the idea is do something which doesn't burn you up with too much detail and do something which doesn't drag you down. Not enough detail. It's all dark. You can't really understand anything from anything else. So just stay in the middle, do something which is reasonable. And this is where the difficult part comes in, because if you have no experience, it's very difficult to say, well, this is reasonable or not. But in this case, I give you an example of what is probably not reasonable. Going around and trying to nail down every single expense in your environment. We'll take a look later at how you can actually change this. Now, we saw cost identification. Now let's move to cost allocation. What is cost allocation all about? What we're trying to do is we want to give better transparency. We want to align IT to business. We want to drive efficiency. We want that people trust the process. But we also want to make sure that this process is actually achievable and we don't want to burn out ourselves. So what we have to do is, for example, there are several methodologies. You cannot try all of them. You will take your lifetime. What you can do is you can look at the methodologies that are available for cost allocation and understand what really matters for you and your stakeholders. So some of the KPIs that you can actually see, I'm showing up right now, and I'm going through through a few of them. For example, simplicity. This is really important. It can become crazy, really. So simplicity of results means that the outcome of your process, when you give it to someone, that someone understands it. It's not so complicated that you will need to explain it yet every single time. So simplicity of results is very important. Second topic is fairness. The whole idea of doing accounting and chargeback is to talk to people about money. And there's nothing else but money that can get people to fight. So you have to be fair in how you do this. Next come another criteria, which is a little difficult to understand if you come from an IT capacity planning perspective, predictability. If you haven't been in a manager position, you probably have seen this, which is, it comes the end of the year and you have to decide how much money you need for next year. So what you do a budget forecast. And some methodologies to do cost allocation are very good towards predictability. Like, for example, headcount that we mentioned previously. Well, you pretty much know how many people you're going to have in your department, or in any case, it's not going to change very much. You have that under your control. So how much budget you will need next year is equal to how many people you will have next year. So it's very predictable. Other means are not that predictable. Then you have controllability, which is how can I actually influence how much I'm paying for? The last one is complexity. Now you see the simplicity on top of results, and then you see complexity of process, which they usually go together, but they can actually might not go together because you can do a very complex process, but the result is very simple, or vice versa. So they are kept as separate. Now, bear with me a little bit of patience. We'll go through a couple of exercises of looking at different methodologies and comparing them. And I only picked two. There are actually 5 or 6 different methodologies. I just picked the two that are most relevant and are mostly used on the field. So let's start, for example, with the one that was in my initial little story. It's based on a similar example, high-low level allocation. How do we do high-low level allocation? And by the way, these are all coming from literature. You can find that these are actually, there has been a nomenclature created for this. What you do is, in order to identify the cost, you just sum everything up. And allocation is based on very simple and predictable drivers. So predictable, simple. Number of employees, or for example, if you take the low-level allocation, number of servers. High or low depends on how technical or how business you are looking at things. Headcount-based IT, accounting and chargeback, is an example of high-level allocation. You pay back to your finance depending how many people work in your department. Very simple. What is the assumption behind this methodology is that the driver, in this case the number of employees, for example, or the number of servers, explains how much you use your infrastructure. This is in general not absolutely true. In a few cases it might be. So it's important to understand what the driver is. This example of high-level allocation is very often used because it's very simple. You do not need to work with IT to generate this cost. Finance can do this on their own, and this is what usually happens, that finance manages this. It's not actually IT. So let's now take a look at some of the criteria that we just mentioned. So how does high-level allocation or low-level allocation score? Simplicity, it's extremely simple, very simple. You have 10 people, the other department has 10 people, you each pay 50%. Very simple. Fairness, well, this is where people don't agree. Well, yes, I have 10 people, but these are field operators, and you have 10 people and you have 10 sales. They are very different people, so they don't use IT resources in the same way. So if departments conduct a different type of business, this is quite unfair. If your BUs all do the same thing, this is actually fair. Let's say, for example, that you are a retail chain. And by the way, thank you for all the people that I know that are attending today for some of the companies we partner with that come from a retail experience. If you're doing this for different stores, well, stores pretty much do the same thing. So using headcount as a driver might actually be fair. So you need to take a look at your environment. Next, predictability. It is quite good from that perspective because you control and you can forecast how many people are going to have. Next one, controllability. Well, this is where this methodology falls. It's if you do, for example, headcount is quite unrelated to IT cost. If you do low-level allocation, number of servers, it might be better, but then number of servers, it's another. So which one is best really depends on what you want to do. Let's take a look at the last criteria for understanding this, scoring criteria. Complexity, it is extremely simple. Once again, as I mentioned, this is what usually finance does. let me actually show you another example, and I'm going to spare you afterwards for all of the other 5 or 6, which will take you much longer than today's 45 minutes. A cost allocation, which is called measure resource utilization. It's very similar to what people usually call pay-per-use. So you define a set of items which you track the usage, how much storage you use, how much CPU consumption, how much memory, how much usage of a shared infrastructure, how many transactions. So you define a simple set of objects, and instead of using a simple and single driver, like in the previous case, you have a multitude of these drivers, and you use them to account how much you're using, depending on the volume of usage of those resources. This is exactly what you get every single month from your gas company or from your power company. Your gas will tell you how much cubic feet of natural gas you have used, if you have natural gas, and your power bill will tell you how many kilowatt hours. So it's a pay-per-use perspective. If we now take a look at our criteria and we define a score for each one, let's take a look. Simplicity. Simplicity means how easy it is for an end user to understand these results. Well, this is where MRU actually kind of falls not so well. So the trust in this process is related to how you are accurate in the process and how well you explain the process. So it's not that simple. Fairness, it's by far considered one of the most fair way of allocating cost. That's why it has become very popular recently. Predictability, not that easy. It's actually one of the worst criteria for MRU. Controllability, well, not so much that we can do. Complexity, yeah, it sounds simple on paper, but it cannot be done actually manually. So why is actually MRU very popular recently? The reason being that fairness is the most important key in this aspect, because we are trying to get IT people and finance people to talk the same language, to be in the same room, to share results. And when people trust the process, they actually like the results. So even if it's, and let me show you a summary. Even if it's not the best in all scores, it actually very low in predictability, and it's not that simple, and it's average in terms of controllability and complexity. It's by far considered one of the most common techniques that you can actually use. Now, this page shows you a summary of other methodologies as well, which I'm not going to explain today. And you can actually see that there isn't really something which excels in everything. So once again, you have to understand what works best for your environment, for your organization, and then use that from there. Now, we look at cost identification, we looked at cost allocation. Now let's take a look at cost recovery. There are essentially 3 ways of doing cost recovery, which you might be familiar and you might have heard before. One is called showback, one is called shameback, and one is called chargeback. Well, you might have really haven't heard shameback very often or used by people, but actually that's what happens. So showback is you generate a monthly, quarterly, yearly, whatever frequency you find useful, a report, and this allows you to give visibility of cost. So this is just to say, hey, business unit X is using 30% of our resources. They're actually not paying for them, but so that you know they're using more. So you're not requiring people to actually pay it back, you're just giving visibility. That's what showback is all about. Shameback, which is half the way between chargeback, and we'll get to chargeback. Shameback is not just giving you visibility, but you actually use it to drive organizational improvements. So not only you know that that BU, that target is actually using more, but you use that information to say, hey, there's something not good there. Why are they using so much of the infrastructure? Is that actually correct? Can we take a look at the winning situations where we can go in and maybe we can save money? So if you were to understand where to start doing some cost saving, the biggest contributions are from the companies that are on top. So that's how you can actually drive out inefficiency out of your environment. The last one is chargeback, where you actually take the results. You have to work with finance for this one, and you actually require the targets to pay money back. This is the most powerful usage, because when people are actually required to take money out of their pockets, BUs in this case, they tend to not abuse of resources. And as you can see, going from the left side, from the showback, to the right side, chargeback, it becomes much more enforceable process. You can drive more cost efficiency, but it becomes also more difficult to have it accepted. So very often companies will start from showback and will gradually move to chargeback when the process is mature and where they're happy and they trust the results. So it's really important to make sure that you trust the results if you're going to do through chargeback. Maybe you're better off start with cost recovery from a showback perspective. When people are happy about those results, you can actually start moving to shameback, which means, hey, business unit X, you know you're the biggest consumer, why is that? And then you might take a look and understand that maybe there's something that you can actually optimize there. Only when people trust your numbers, remember to go back to the criteria, trust is very important, fairness is very important, simplicity is another one, then you might want to move to chargeback. And now a lot of people actually debate whether the quote, with great power comes great responsibility, actually comes from Spider-Man. Some people say, no, it comes from Voltaire. Well, it actually does come from Spider-Man, the comic book. Most people actually think that it's from Peter Parker. No, it's not even from Uncle's Ben. It was actually a narrative voice. So it's really important that when you go to chargeback, you have in your hands, together with finance, great power, because it means that you are actually shaping how people use the infrastructure, not just because they need to use it, but because they are actually going to have to pay for it. So that drives a lot of organizational changes. So it's really important that when you get there, you need to make sure that whatever you do is trustable and it's accepted and people are on board with that. Okay, now that we talk about generic concepts and we have looked at some of the techniques that are available, we looked at just a couple, as I mentioned, there are at least 5 or 6. And some of the concepts that we looked at were generic. Now let's take a look at some of the things that are specific to TrueSight capacity optimization. Let's take a look at the workflow. All right. So we have a series of steps that you can take. These are generic, but they start to become specific to capacity optimization, which means that you might find the same steps in your own process, which you create in Excel or even in other products, but these are very true to capacity optimization, how it works. So the first step is define a target hierarchy, which means who is going to receive the bills within your organization. This might be people, there might be BUs, there might be managers, but it's important to understand what is the hierarchy of targets. So first step, identify your targets. Second steps, which comes from a different area, is identify your cost objects. Cost objects means this is the cost identification part. The objects which are going to generate in the measured resource utilization perspective the actual cost, which can be usage of CPU, usage of memory, usage of storage, usage of network, number of transactions. What are the technical objects which are generating cost? Licenses. And we're going to call them cost objects. The next step is, once you have identified these cost objects, you define the cost rates. Okay, we want to count how much CPUs are being used. Fine, we can take a look at CPU utilization. Every capacity planner knows that. But what is the cost of a CPU utilization for a certain amount of time? That's a tricky question. So defining cost rate is the next step. Once you have that information, you have to look at the allocation perspective. Remember the second step, cost allocation, which means, okay, we have a set of resources. Who is actually using them? You might see that we are going in the C&B direction. The last step is at that point you can actually create. So you see that once you have all of the ingredients, the hierarchy, the cost object, the cost rates, and the allocation, well, at that point, chargeback or showback comes by itself. It's really not a complicated process. It's a giant calculator where you put in that information, it sums up everything and it gives you the result at the end. So let's go through this process. First one is define target hierarchy. Now, you might have an organization which is split in departments, business units like R&D, sales, production, and each one of them might be running one or more applications. So this is where you have to define how you will roll up cost. What are departments? What are the targets? What are the BUs? You need to put a name and a face to them so that you can actually identify them. Ideally, that information is available somewhere because you don't really want to manage this manually. If you are familiar with capacity optimization, you might see that where we are going is actually towards your domain tree, the workspace. In the workspace, you have things organized in a certain way. And by the way you organize them for capacity planning very often is very similar to what you do from a accounting and chargeback perspective. It might not be the same, it might be similar, but you are going to probably use the same set of information. Next step in our process, where step number 2, is we define cost objects. Cost object, and I'm presenting some of the common ones, can be a database, can be storage, can be servers, can be network. And whenever you identify this, you have to identify the type of cost, capital, operational, whether it's hardware, software, is it labor, is it direct cost, is it a share cost. This metadata comes helpful. It's not strictly required to identify cost objects, but when you identify them, just make sure you mark down some of this information. It will become helpful when you have to build the cost rates. For example, how do you account for the usage of a network? How do you account for the usage of a CPU or a database or storage? Is it something that, for example, a license, once you buy it, whether you use it or not, it's a fixed cost? Or is it something that, well, it's an externally provided service, so we pay per use an external providers, might be allocation. So there are several ways on how you actually account for the cost of the objects, which takes us to this next step. Once you have identified all of the cost objects, you have to understand for each one of them what makes sense. And trust me, there's not a definite answer. There is not a right or wrong answer here. It's more of a matter of understanding what makes sense for your environment. If we look in general, there are really 3 categories of type of metering and accounting once you have identified cost objects. There are cost objects which are called fixed rate. What does fixed rate mean? It means that if you have 3 different types of cost rates, no matter how much you use them, like you see here, there was some here, some additional things were bought afterwards, the cost is the same. Once you have it, that's a fixed rate. It only depends on the amount of time you have been using. For the mathematically inclined, the cost is actually given by the amount of time, and it's a fixed cost rate. It doesn't depend on anything else. We also call this all you can eat. You have it, you pay for it, whether you use it or not. Second type of cost allocation is indeed called allocation, which means, well, the more you have, the more you pay. Previously, well, you could have 1, 10, 100, you have it, you pay for it. This one is more about how much you are actually using, whether you're using it or not. For example, storage. Well, here's a terabyte of storage. You use it or not, it's for you. It's not shared, so if you're not using it, you're just wasting it. So in this case, as you can see, the cost increases with how much you actually own. So if we add storage and servers here, you see that the cost of those 2 cost items will increase. For the mathematical inclined, cost is now a function of quantity. And we call this subscription based. You buy a certain amount of licenses. The last methodology, which is probably what everyone wants to use, but it's probably the most complex one, is utilization based. Well, we have a CPU and we want to charge our internal targets for how much they're using that CPU, no matter what. So it's really a truly pay-per-use perspective. You have, for example, storage, you have servers, you have network, and depending on at one point in time how much you're using, you're going to pay for it. So this is the truly metered usage. And as you can see at this point, things start depending on how much you're using at a specific point in time, for how long, and what is the cost rate. So it becomes a little bit more complex, and we call it per use, which is the true nature of the measured resource utilization perspective. The other cost accounting methodologies can be used in other areas too. Next step is we associate cost object to targets. Let's say that we're done with our process previously. We've done everything. Now we have to say that that cost object has to be paid by that target. There are essentially two ways of doing this. There is a way which is called named and a way which is called quantity. And here I'm going towards something which is specific of capacity optimization. Name is, for example, if you department sales own a set of applications and each of that application has a certain amount of resources, that's what we call named. Because we have a list of the resources that you are actually using, you're going to pay for those specific items. We know how to account the cost for each item. We know which items you actually are using. So to generate the bill, it's simply you have item 1, item 2, item 3, and we know the cost of each single one of them. We're going to sum them up, and this is the total cost to you. Quantity is, on the other side, something which is related, for example, to external costs. If you are paying licenses, for example, you can import and say, well, that business unit department or target has to pay a certain amount of licenses, and you can import that information. By far, named is 99% of the time what you want to use within capacity optimization. Quantity is really related to very specific exceptions. Name is what you want to use. Now, if we put all of this together, we can see that we start from the resource consumption perspective, which is very common to capacity planning. So we have a set of resources. We determine the resource utilization. We compute the resource consumption, and we have these resource consumption reports. If we now add cost rates to the equation, we take consumption, we have cost. Because remember that consumption times rate is equal cost. So we have a cost accounting report. We know that that server costs this amount of money. Next, we take what we call the hierarchies and the cost allocations perspective. So now you see that the cost model is made up of cost rates, hierarchies, and cost allocations. So now that we have the cost of each single item, which is generated by the cost rate and the consumption model, we can turn back and say, well, this server was used by this application owned by this department, so this department has to pay this amount. And that's where we get to the chargeback report. Whether it's showback, shameback, or chargeback, we still call it chargeback. Now, as you might have seen by now, I went through a lot of concepts, a lot of things, a lot of examples. By the way, let me know if you'd like to see more in another webinar about some more specific examples. We will take maybe some other webinars to give you some other example, and I actually have them. But I wanted to close today is with some of the common challenges and lessons learned, and hopefully before we later in a few minutes open up for Q&A, how you can actually diffuse these challenges. First one is, this process is all about trust. That's the most important task of this initiative. You have to work with IT people and finance and get them in the same room and get them to talk the same language. My very first accounting and chargeback initiative that I helped at oil and gas company back in Europe, it took me 6 months to get finance and IT to talk the same language. And really, I don't want you to go through the same process. So really spend an amount of time into making sure that people trust and people talk the same language. And how can you actually do this? You have to create prototypes. You have to create something, see if it works, present it, go back at the drawing board, redo it again. Where can actually technology helps you is that, well, if you had to do this in Excel, you will go insane. It will take you years to develop a new prototype every single time. As you've seen earlier, once you have a certain type of ingredients, cost rates, items, charge hierarchies, recreating new cost model is fairly simple. So the benefit of using capacity optimization in this case is that you can generate new models, new examples very quickly. Once you have the data, it's very easy to create a new model, present it, and see, how do you feel about this? Is it simple enough? Do you trust the data? Does it have enough details? The second challenge is that cost rates are the most difficult part of this. That's why earlier I told you about bottom-up approach, top-down. This is very difficult, so you have to apply some approximation. Some of the things that I learned is that it's important to have cost rates that are variable over time, and capacity optimization can help you with this because you can define that the cost of a server, for example, depends on when it was acquired, and it also depends on the model. So you can use configuration data and you can use time to define cost rates that are different according to the fact that a server is a big server or a small server, and depending on the fact that you're looking at consumption of that server in 2015 or 2016, because costs were different. So technology here actually helps you. It's still a complicated process, but technology gives you a hand. The last one is that if you put all of this together, it's a very complex. So the process itself is very simple, but complexity comes in the amount of information that you need to manage. Keeping up with all of this manually, it's really impossible. So this is where you can actually leverage things that are already in place within capacity optimization for other purposes, like the hierarchy structure is very often a subset or a simplified version of your CNDB information. You can automatically import within capacity optimization so that once you set up a complete example of a cost accounting exercise on one service, you take it, you replicate it to 150 with one click. You don't have to do it for every single other application. You have done it for one and you just replicate it all the way. And from now on, all of the updating, everything else is going to be managed manually, automatically by capacity optimization. And with these end of challenges, I would like to turn back to Gabriele for your daily dose of good action.
Well, thanks very much, Renato. You provide us with a wealth of information, and I'm sure everybody enjoyed how you dig into this topic. Before we move to Q&A, I would like you to remember to subscribe to our blogs so that you can be notified about upcoming webinars and in general everything that Moviri is about to provide to you, whether it is capacity, whether it is analytics, security, or all the other things that Moviri does. Now it's time for the Q&A. And I kindly ask you, if you have a question, to post it into the question area of your GoToMeeting client. And let's see if there are some questions coming, question or comment anyway. Okay, here is the first one. Let me read it. What if I have a device shared by different applications, but I can quantify how much of it is being used? Renato, do you have an answer for that?
Yeah. Sometimes you have shared infrastructures. Let's say, for example, a load balancer used by many applications. It's very difficult to keep track. You could in theory, but then in practice it becomes very difficult to keep track of how much each application is using out of that load balancer. So there is actually a common technique which is called fair use of a shared infrastructure, which says we'll take the cost of that object and we'll divide it equally by how many services are using that cost object. For example, let me make it real. You have a load balancer, and if today that load balancer is used by 2 services, then each one of them will pay 50%. If tomorrow is used by 4 services, each one of them will pay 25%. And the fact that someone uses a certain cost object, which in configuration management words, which will mean that there is a relationship between configuration items, service uses another item, load balancer. You have that information in CNDB and you can automate all of that information. So in summary, if you have no better way of saying who is using what of that shared infrastructure, you can use this concept of fair use, which is, well, there are a certain amount of people using that infrastructure, we'll just split the cost equally. That's a very commonly adopted technique. And by the way, it is available in capacity optimization so that you can say, well, for this specific cost object, just do fair usage. So the more people use it, the more we split it up, and we split it evenly between everyone that uses it today.
Thanks very much. I believe we have time for another question. And well, I see that there is one which apparently could be kind of follow-up for the previous one. And the question is, I have a large shared Hadoop cluster. So we're still in this shared services mode. How can I charge back users to different business units?
Right. So if you have different business units and they all use the same cluster, and you say, well, I do know that each business unit is using the Hadoop cluster in a different way, so I don't want to use fair use. I don't want to split it evenly. What you should do, you should identify what driver, remember the high level, low level allocation example, what driver actually drives the cost of the usage of the infrastructure. For example, it could be the number of MapReduce jobs. It could be the amount of resources being used. That's from an accounting perspective. The next perspective, remember, you have cost identification. So how do you identify what is a cost? Is it the usage of resources? Is it the amount of workload being generated? That's step one. The next step will be charge that usage to someone, which is, okay, now that we know that we want to charge by how much CPU is being used or by how many MapReduce jobs are being used, how do we keep track of that? Well, that's where you have to identify out of a shared infrastructure how to relate a job which is running for someone. It could be that if you are running jobs with different user IDs, you need to know that that user ID belongs to someone. Or you can take a look at the job name and hopefully you can say, well, yeah, that job actually belongs to Department X. Or you might track that information somewhere else. So you need a way to allocate the workload to someone, whether that comes from the user ID, from the pool where these things are running, from the name of the job. You need to find that way. Once you have done these two type of activities, identify what you want to people pay for and how you want to allocate the cost, how you can allocate the cost, then you put together the information and you have your new the specific technology for Hadoop clusters, which means that the process is the same that you apply everywhere else, but when it comes to Hadoop clusters, they're a little bit more complex things that you might do. This also applies to database as well. How do you determine the usage of a shared database? Well, if you know who's running queries, you can use that information. Or if you know how many resources are dedicated to a schema, you can go by schema. So you have to find a way first to identify the cost and second to allocate them. And then it becomes yet another exercise like everything else.
All right, thanks very much, Renato, for the answer. Unfortunately, the time is up. So let me thank you everybody for attending this webinar. And again, don't forget to subscribe to have news about upcoming webinars.